Okay, I've got 1 o'clock. So we'll go ahead and get started here. Welcome to the May Crop and Livestock Outlook. It's brought to you by the Division of Applied Social Sciences, and within that division, the Food and Ag Policy Research Institute, and our colleagues over at MU and Extension in Ag Business and Policy. So today, our speakers are myself, Marty Foreman, and Wesley Tucker, who's standing in for Scott Brown. So make sure you ask lots of hard questions about livestock. We appreciate everybody being able to call in today, and please ask questions. There's a lot of uncertainty going on out there, and as I wrote this, I was like, we need some positive news. And so one of the things that you're going to find me starting with on the special topics section is some positive news, at least in terms of some help on dealing with some of these falling prices, trying to figure out, what are we going to do with excess supplies? How, what programs are starting to come out there? If you have employees, what kinds of programs are out there that might help you cover labor cost and even and that type of thing. And unlike a lot of businesses, farming goes on, and there's the work always has to get done. And so I know a lot of you aren't in the position where you felt like there wasn't anything to do. That's never something I found to be true on the farm. There's always something to do, and more of it than you can get done. So then we'll talk about some programs related to that may help as well. So with that, I'm going to jump right in. I want to talk about this in kind of different phases. And I want to start with a little bit of a disclaimer. The disclaimer simply is that we don't have a lot of details yet on how exactly these programs are going to be implemented. So I want to start with that and make that very clear. What I'm trying to give you is kind of what's been announced, what's been talked about, and I'm going to start with what's passed, what's already in place. And then as I get towards the end of this section, I'll be talking about things that are under discussion but aren't quite in place. So I'll try to make sure I emphasize that as I go through. So I want to start with CARES. This is passed legislation. And you can see in this pass for agriculture, there was $16 billion allocated to direct payments and $3 billion allocated to product purchases. And so if you then take that $16 billion and you break it down and you look at that right-hand pie chart, you can see roughly how that was allocated. Now, one of the things I wanted to say about that is that allocation isn't necessarily exactly how everything will get allocated, because when they calculate the payments, it may be that one category is a little over and one category is a little under. So there's some flexibility in how those payments might be spread among the different types of commodities that are listed there. So kind of keep that in mind. Now, so what's going to happen with that? Well, these direct payments really are designed to help producers adjust to the market conditions that resulted in less demand as a result of COVID-19. So when you start to look at how they're going to administer the direct payments, that $16 billion, it's really going to be in response to the price declines. And so if a commodity is going to get a payment, the price of that commodity must have declined at least 5% between January and April. For almost every commodity, that's not an issue. Everything has declined more than 5%. So for most commodities should be eligible under the program. So they're also talking about then two different sets of payments. So the first payment would be based upon your price losses from January 1 to April 15th. Sometime between the 15th and the 17th. We haven't got the official date yet, but, and so over that time period, what we'll see is if if the price declined by, let's say, just to make the numbers easy, $1 a bushel, producers would get compensated for 85% of that dollar a bushel. So they get 85 cents a bushel. And then the next payment um, would be over based on losses from April 15th to 17th over the next 2 quarters. And so, of course, we're not close to that getting out to 2 quarters yet, but producers would get compensated for 30% of the loss over the next 2 quarters. So if you were like me and didn't get your corn priced when you should have, back in early January, February timeline, and you still have a bin load of it left, you will be able to, in theory, make up some of the price difference between January and April, from with a payment from the government. Now, there are other things, as usual, that apply. It's things like payment limitations that you must keep in mind. And what I'm wondering about is, depending on how many people apply for this, um, to what extent, will they be able to expand the funds if there's too much demand? The questions I don't know the answer to. So, but the good news is at least they're thinking along this line, and there is some help coming. And so we don't know exactly when it will start. I did read in one announcement that they were hoping to get this first round of payments out in May. That's pretty aggressive given where we are, but it might happen. So, but they are trying to get those payments moving. The second piece, that $3 billion that I was referring to on the purchase programs. So I've stepped from the direct payments to the purchase programs now. Just wanted to give you kind of a little bit of a breakdown on how that's working. Section 32 purchases, which I'll talk about here in a second, is directed at livestock and fruits and vegetables. $470 million worth of payment, worth of purchases right now. And then you have the Farmers to Families box program. That's really the $3 billion. And the way that they're intending to spend that is $100 million per month on each of fruits and vegetables, dairy products, and meat products. And then there's the Emergency Food Assistance Program. It's got $850 million attached to it. And if you remember from last year, there was already a program in place under the market facilitation payments to buy some additional products off the market as part of that program from back in 2019. So in total, right now out there, what's lurking around is $4.89 billion worth of commodity type purchases. And there's a lot more detail coming on. There was a webcast on the Farmers to Families box program last week, and they're going to keep pushing out more and more details and information if you want to participate in that type of a program. Just to give you a sense for that first one, the Section 32 one, how it was broken up across the specialty crops and livestock. You can see, just what was surprising to me was I didn't really realize it, but how prevalent the fish, the haddock, pollock, redfish, $40 million, catfish, $30 million, right up there in terms of some of the payments for the products that they are planning to purchase. So, just a little news there. So we know that if you have had employees in the past, and there is a program that they started back in April called the Payment Protection Program, which was designed to help employers retain employees when they otherwise might have had to let them go because they couldn't afford to keep them. And what this does is it's basically, they describe it as a kind of a forgivable loan. So you can go in and show them your past payroll and say, hey, this is what I typically spend over this period of time. And you can with really fairly minimal paperwork, you can get a loan for the payroll cost. If for some reason you had a business office, rent would be our interest on mortgages for a business type office, utilities, that type of thing, are things that could be covered. And the only condition is for it to be a loan that is forgiven is that you must spend at least, or you must use the funds for at least 75%, or at least 75% of those funds on payroll. And you must retain the employees. So that program, we're in round 2. We're actually getting probably to the very close to running out of funds on that. Again, but if you haven't gone through an application process, there's discussion of a round 3. And if you just want to get your foot in the door, and you may say, well, it might be too late, but at least you could go down that route. And so you can also see there at the bottom a link to some additional details about the program. If you find a participating bank in your area, you start by working with the bank and talking to them and telling them what you want to do, and then they'll get you started in the paperwork process and hook you up to the links to actually make the application. It is not too onerous. So the other thing is the Secretary of Ag clarified that the SBA economic injury disaster loans, farmers can apply for those. Before it was farmers were being told, no, you can't, you're not eligible for this program. But yes, in fact, farmers are eligible for the program. It is a true loan program, although part of the program, what's interesting about it is if you go in, you apply for the loan and you get all your paperwork done, they're supposedly giving $10,000 to you right up front, even if before the approval on the loan is made. And that $10,000 does not have to be paid back even if you're not approved for the loan. So, but you do have to be able to show that you've had financial hardship as a result of the coronavirus outbreak. And there's more details there also listed on that link. So now I'm going to switch from what's been approved, policy in place, now to what's being discussed. And so keep in mind, this is legislation that is moving through the House, but the Senate has not really fully endorsed this yet. I think there will be some compromises, but this may at least shape give you some idea of the framework of discussions that are happening right now. And so there's some things in there for crops and livestock. On the crop side, on the renewable fuels, there is a piece in there that would give renewable fuel producers 45 cents a gallon for fuel produced during the January to May period. As you know, many of the ethanol plants have been under significant pressure due to the low ethanol prices and the weaker demand for gasoline for transportation. And so that weaker demand, because the ethanol policy, the RFS, is enforced through a blend rate announced by EPA way back in December of last year. Less demand for overall fuel translates into less demand for ethanol. Now that will reset when we start to look at 2021, because then the volume obligation relative to the amount of transportation fuel that is anticipated to be demanded should change the blend rate a bit, so that more ethanol gets used if in fact we continue with a lower transportation gasoline demand overall. So, but for this year, this is a program that would compensate the ethanol producers for this period of very low transportation gasoline demand. There's also a section in there that provides another $16.5 billion for direct payments to agricultural producers. Again, probably mostly on the crop side, but I don't know that. There could be some other things. And then there's a lot of details here on sort of the foreshadowing of legislation regarding livestock and dairy. So there's some things in here that basically designed to protect livestock producers and help those producers that have been forced to euthanize their animals, that type of thing. There are some things in here that deal with disposal of livestock and poultry in terms of how that can be handled if the animals can't be moved to processing plants. It's really trying to also set up programs to help capture products that are being produced, such as milk, to kind of prevent dumping milk and facilitate the transfer of that milk instead to a direct donation program. So lots of little different things here. I'm going to let you look at the rest of that, but just some things that are out there under discussion. Nothing set in stone here, and there's nothing that at all is law yet. Just some things that are being discussed. So now, how about some other news? So I guess on the bright spot with China, the thing that I would say that is important, or at least signs of progress, is it does look like China's on its way to filling its TRQ for corn this year. Now, remember, they don't have to buy all of that corn from the United States, but it is, at least in the past, they haven't really been doing this. And so it gives us another couple 100 million bushels of demand out there on the marketplace, and that's worth probably about 15 to 20 cents on the corn price. And so every little bit helps. And so this is good news. This is a bit of a bright spot out there. Now, I wanted to take you through sort of some changes from USDA. Everybody's been talking about COVID-19 and its impacts and what's happened. And so what I did was, these are slides, what you're seeing here, except for the comments on the right. The slide is from the U.S. Secretary of Ag briefing on May 12th. So just a few days ago, when the Secretary was briefed on the latest data. So first of all, the blue column, the blue numbers there, are just the change from last month for 2019-20. So it's that marketing year we're currently in, and how much have those estimates changed from last month. And then the column that's on the far right, it's either red or green. I apologize, colorblind here. But the far right column that says change from 2019 to 20 is the change is the USDA's first forecast of the 2020-2021 marketing year. In the case of livestock, this is going to be 2021 and calendar year. So the meat numbers are calendar year. Now, so let's look at that blue column a little bit first. You'll notice some trimming. So you see the trimming in corn consumption, and you see kind of a significant trim in soybean oil consumption. I'm just picking on the two big numbers first. We'll come back and touch cotton here in a second. But those two are largely the result of the change in transportation demand. And so that's lowering the quantity of ethanol and biodiesel that needs to be blended this year, because we're not consuming as much gasoline and biodiesel. So that's part of what's feeding into those lower numbers for the 2019-2020 marketing year. Now, I'm going to come back to cotton here in a second. Now, one of the things with cotton, I feel like this is a highly uncertain market. USDA has been, in my view, fairly conservative about their projections in terms of how bad cotton might be hit, simply because of the demand for clothing and subsequently translating into reduced demand for textile mills, and anything related to clothing production. So I'm a little bit concerned about that. I think what USDA is putting out here for cotton might be mild relative to what we might experience. Now you can see down at the bottom there the change in meat consumption. So you can see some pretty healthy changes in beef, pork, broilers, down altogether almost 4 billion pounds. I don't want to steal a lot of thunder from what Wesley's going to talk about, but pretty big changes on the meat side. Now let's look at 2021. I'm going to look at that far right column now. So let's look at so you see a lot of positive growth in demand. And so on the ethanol side, ethanol and feed demand are responsible for that 595 million bushels in growth. You can also see on the soybean oil side, about 500 million pounds of that is biodiesel, and the other 300 million pounds is food use. You see some soybean meal use. That's has to be kind of based on the notion that we are going to see the livestock sector recover fairly quickly. And that's one of my other cautions. One of the areas of risk, I think, given the type of economic effect that we've had with this particular shock, is can we recover as quickly as we did from the Great Recession back in 2008 and 2009? My guess is we may not be able to spring back quite that quick. And so I'm worried a little bit about how optimistic we are about bringing that meat consumption back. But we'll let Wesley tell us more about that. On the export side, what about outside the U.S. in terms of looking at demand around the world? Look at that change in U.S. corn exports. I think it's possible, actually. I believe that's doable. And the reason in part is there's some bargains for some of our international customers right now. The corn price is frankly too low. And so it's created some bargains out there for folks, and they should be taking advantage of those. As we look at, thinking about the soybean side, a lot of that is going to depend upon how South America responds and the value of the real, Brazilian real, and I'll talk about that in just a second. The cotton recovery. Well, if we are going to get a recovery in cotton exports, USDA is showing a little bit lower price, but I'm guessing that price may be feeling a little more pressure than what's been let out there, right? What USDA is expecting. Those mills are going to have to get back online pretty quick here, and those clothing orders are going to have to pick back up to make that happen. And then you can see the recovery in meat production. That probably can happen, but not meat production, in meat exports, but it's going to depend a lot on what happens in China, and whether we can actually, depending on what our competitors do as well, what's happening in Europe, what's happening in Brazil and other areas. So overall, on U.S. production, we all saw the U.S. WASDE report. We've seen how much more additional corn production we're looking for in 2020, almost 16 billion bushels. That's something that we're going to have to figure out how we absorb in the market, and, how much weight our ending stock's going to put on prices. You can see the soybean oil and meal also increasing in production, as well as soybeans. And so overall, we've got production recovering with are growing in a pretty significant way. And so with that, I'm going to go ahead and move to prices. So remember, the blue is just the change from last month. So if you want to look at which commodities have had a lot of pressure, you can do that through this. If you look at what's happened, what's probably more interesting is what's anticipated for next year. And so look at this: the rice price, the corn price, and the soybean price. The corn and soybean price, in particular, weaker, relatively significantly weaker, and that's what they're anticipating in this first projection out. Now, notice that a lot can happen, though. There's still, we haven't, we're assuming fairly optimal growing conditions and all of that type of thing. And so a lot can change in terms of what happens with these commodity prices. Okay, so let me go ahead and skip forward to this is the other thing I want to kind of warn you about a little bit, is what's happening with the Brazilian exchange rate. The value of the Brazilian dollar has, continuously declined. And so it's really a significant development, because it makes their products look cheaper to other international countries. And so if you look here, it's almost 5.8 it touched there a few days ago in terms of the number of reals per dollar. So their currency's gotten very weak. It makes their products even more competitive with U.S. products. And so that's one of the things to kind of keep an eye on. So with that, I'm going to stop there and pass it over to Marty and let him get started with the corn outlook.
Okay, thanks, John. So the most significant thing about the the May WASDE is the fact that USDA always begins the sort of the first official estimates of the new crop marketing year. So, and John covered some of that ground already. This is the supply demand table for corn. I guess we'll just kind of walk through some of these numbers without hopefully repeating too much of what John covered. One of the unusual things that did happen this month is the production was revised down a little bit for the old crop for the 2019-20 marketing year. Revised the production down 29 million bushels. Typically at this point, we're not still trying to figure out how much we produced last year. Of course, we had some of the late harvest in the northern plains. Some of that crop wasn't harvested even when they were producing or surveying for the January annual production report. So therefore, the USDA went back and resurveyed the folks that indicated they had unharvested corn in the field at that point. So there were 4 states, I think Michigan, Minnesota, South Dakota, and Wisconsin resurveyed, and that netted a 29 million bushel cut. They did indicate they're going to also contact folks in farmers with unharvested corn in North Dakota. And so adjustments, or could be further adjustments to that production number in June to reflect whatever changes they see for production in North Dakota. So anyway, a small cut in the production. On the demand side, the feed and residual was up 25 million bushels from last month, so a little bit stronger feed and residual. That's probably because of the fact that they cut the ethanol production a little bit more, fewer DDGs, so more maybe more corn, raw corn feeding as a result of that. So the domestic use was down a little bit once again. One thing I would say here, back on the ethanol front, so this 100 million bushel revision to ethanol this past month, that's if we look combine, downward revision in April and then again this month, we're looking at a 475 million bushel cut in that ethanol production, and we may see some further downward revisions in the months ahead. Exports, they nudged them up by 50 million bushels. We'll talk a little bit more about that in a minute. And then ending stocks with the net of all of that was just a modest increase from last month to close to 2.1 billion bushels, with the season average price lowered from 380 down to 360, so about flat with 2018-19. At this point, a lot of the focus is really looking at 2021 marketing year. As I mentioned, this is the first sort of official forecast for the new crop. And so USDA always plugs in the planting intentions estimate for their acreage and then works the harvested acreage number up off of that. The 97 million and then a trend line yield of 178.5 bushels an acre, which would, even though it's a trend line, would be a new record high yield for corn, by the way. And that gives us this nearly 16 billion bushel crop next year. So a record by a wide margin there. Total supplies over 18 billion bushels. John covered some of this ground here on the feed and residual use increases. So some of this increase in the feed and residual is probably tied up with the residual. You tend to have a higher residual with larger crop size. That's fairly highly correlated. So some of that increase there. Then expecting a bit of a rebound in the corn for ethanol. And so we have total domestic up to 12.65 billion, and then total use up to 14.8 billion, which gives us a carryover all the way up to 3.3 billion bushels. So a huge, really kind of a huge increase year to year in this ending stocks number. And I guess I would also mention that we did have a projection from the USDA back at the in February from the Outlook conference, Outlook Forum in Washington, and they at that point were projecting this ending stocks number to be closer to 2.6 billion. But they were also dialing in a little lower acreage number at that point. So with intentions up here at 97 million, we had larger production and caused this, and without kind of an offsetting increase in use, we wound up with this much larger stocks number, and then the price at 320 per bushel, 40 cent per bushel decline. This slide just covers the export pace, and one good news on corn is that the exports have improved here over the last 8-10 weeks or so. So we're running a lot stronger pace of exports, and it looks like we've got a shot at certainly reaching the revised number of USDA at 1775, and maybe even exceeding that by a little bit. If we can continue this, probably not going to stay on track with the 2015-16, where we wound up at close to 2 billion for exports. So probably looking at something closer to 1.8, maybe 1.85 billion in final analysis for corn exports. Here's the corn production. You can see the kind of increase year over year there that we're looking at. I think it's a 17% increase from last year on corn production. One of the things that's going to, we'll talk about the production estimate again in a minute. I wanted to point out here, I had this slide in last month, is showing the weekly ethanol production in stocks. Probably could use a little more labeling on this slide, but the production, which is the black line, you're reading over here on the left-hand axis. And so we fell below 160 million gallons a few weeks ago. We've seen ethanol production rebound a little bit. I think the latest report earlier, I guess from yesterday, was 181 million gallons. And as we've seen production bump up, we've seen the stocks numbers come down. So we've got looking at reading that over here on the right-hand side, about, I think it's about a billion, 1.015 stocks number. And so we're down pretty significantly from that peak a few weeks ago on the stocks. I guess the assumption that USDA is making on the 49.50 on the ethanol use is we really need to see this black line track up here close to 260 or so for the rest of the marketing year if we're going to reach that number. So we're down something like 40% from a year ago at this point. We need to be down more like 10-12% year over year. Which means this black line needs to move up here towards about 260 if we're going to reach that forecast. So that's why I suggest there's maybe some risk to some further downward adjustments in the ethanol forecast. The stocks to use and price slide, you can see the blue bar over here on the right. You're reading that on the right-hand axis. So we're up to over 22% stocks to use based on the USDA's projections at present. A huge really increase in that stocks to use, and would be the highest, going all the way back to 1992, 93. So clearly a large stocks build on corn. The red line is the season average price. You can see we've got that plugged in here at 320, reading over here off the left-hand axis. Now, I guess one of my concerns would just be the fact that with this stocks, these kinds of stocks numbers, I'm afraid we're going to start hearing people, want to talk about corn prices averaging down here in the twos. In the past, when we've had stocks up, anywhere near this kind of number, back in, early 2000s, we had much lower corn prices. I'm not projecting or forecasting that's going to be the case this year, but you probably hear people in the trade, the bears, pointing to that, that possibility. Planting progress. We moved to 67% planting progress as of Sunday. You can see that's well above the 10-year average. It's about 55%, so running above average on planting progress nationally, and of course well above where we were a year ago, which I think is 28% or something like that. So much better planting progress on corn this year. Here in Missouri, we were also 67% planted. Versus a little behind in Missouri at 78%, and well above last year at 44%. One of the things that is going on, though, is we've had all this cool weather, so emergence has been slow. So the emergence in Missouri in particular is only 33% versus 51% average. So even though we had some fast early planting, the cool weather has slowed the emergence a bit. I would say, though, generally speaking, the trade is seeing this fast planting pace as positive for acreage in a sense, and also positive to the outlook for yields. One thing, we had this slide last month, but we're also seeing the market trying to encourage farmers to, maybe shift a little more of these acres to soybean. So the soybean corn price ratio, which is just the November futures price divided by the December corn price, up here over 2.5 to 1, which favors, just kind of as a rule of thumb, favors soybeans over corn. So we've seen a pretty big change, from back last fall, and then certainly from early this spring with the soybean price gaining on corn. So the market's, or at least the soybean market's trying to bid some of these acres away from corn. This is the 97 million acres from planting intentions. I think the trade is probably anticipating maybe 1 million comes off of this, maybe 2 million. But I should point out that, it's really, barring planting delays, which is really not the case this year, you don't see the acreage number, from June, which will be the next surveyed estimate for acreage. You typically don't see this come down much more than 1 million acres, and that's usually associated with some kind of a planting delay. So it'd be a little bit of a historical deviation, I guess, if we see more than 1 million acres come off of that number. Also, trade's looking at the soil moisture. So we've got a lot of soil moisture here across the Midwest. So we do have some cushion in that respect. So if we do move into a little bit of a drier pattern, which is actually in the forecast, the 6 to 10 day to 14 day forecast is calling for warmer and drier, which I think the trade sees as a positive for the crop. One thing that's been happening is the funds have been fairly aggressive sellers. And this is actually as of most recent data, which is a week ago Tuesday. And so since then, I think the funds have probably added to their short position. So they're looking at a position, I'm guessing here, probably 220, 230,000 net short in the corn market. We've seen prices come down as the funds have been selling. I guess the flip side of this, which could be a positive, if we do see something that would trigger a little bit of a recovery rally, the funds coming back out of these short positions could help fuel say a sort of late spring, early summer rally. But so far we're lacking any kind of a trigger to generate that kind of short covering out of the fund sector. On the charts, just quickly, we're really seeing the nearby futures. This is a monthly chart going back to 2005 here. So each one of those bars is a month's worth of trade. See, we've got the prices down here testing what I would call long-term support down around 315. You can also see these lows back a few times back in 2008 and 9, and then again in 2016. Down around $3. So we're moving into an area of long-term support. I would call it between about 3 and 315. We'll see if the market can hold that level of support. Just looking at the December contract, we've really been in kind of a consolidation mode here of late. I was a little bit optimistic because when we saw the report numbers, and I kind of viewed them as a little bit negative, the market really didn't respond that badly. But since then, the last 2 days, prices have been weak, and now we're threatening to make a test of the contract lows here on the December corn futures. So I think those are important levels to keep an eye on. We see those give way, then we're probably looking at another say quick leg down in prices here over the near term. As far as where can this thing go back on the upside, so if we were to have a kind of a seasonal rally, or maybe a weather threat that comes in, maybe some of this demand from China shows up, you're probably looking at something back, I would guess, between about 355 and maybe 365 on the upside. Anything close to $4, I think, is going to require a pretty significant weather threat, something that would threaten to maybe cut 10 or 12 bushels off of that national average yield. So rather than a 178, 179, something well below 170, that kind of a threat I think would be required to push this December futures back up to that $4 mark. So I guess just to summarize, here are some of the, I think, the sort of the headlines. There's certainly more things that can go on here. We've talked about the ethanol, I think, is still at risk. Exports and feed use a little stronger. We've got a fast planting pace, which is a little bit supportive to the strong yield for corn. But the real headline, I think, for the new crop is just this big production number kind of swamping the demand, even fairly significant increases in demand in this large stocks increase from this year to next year. And then we've got prices testing these long-term support zone between 3 and 315. So with that, I'm going to hand it back to John on the soybeans.
Okay, on the soybean side, really not too much of a big change from last month in terms of the 2019-20 outlook, except for exports. And I think USDA finally had to reconcile a little bit. They were probably a little too optimistic, and we've been talking about this the last 2 months. Those Chinese purchases that everybody was expecting sort of never showed up, and that's partially because the Brazilian real has devalued so much, and it's made their soybeans look less expensive relative to U.S. beans. And so that's part of why for 2019 at least, we haven't been able to get as many exports out there. They did revise the soybean price down a little bit from last month. So now we're looking at a season average for 2019-20 of $8.50. So that doesn't, bode well for at least the next few months in terms of where USDA is expecting prices to go. as we look at 2021, first thing you should notice is we're coming up to at least at this particular area number, and I wouldn't be surprised if we don't end up finding a few more of those acres at the end of the day. We're sitting at 4.1 billion bushels of production. We do have a pretty significant increase, a USDA does in soybean exports, and I'm going to say we're going to have to keep an eye on South America to see if we're able to pull that off. But you'll notice that the soybean price is still $8.20 a bushel, and it's and nobody's really excited about that. So we'll see what happens. That's perhaps not the best news, but maybe we'll start to see some positives come out of China purchases as we start to look around August and September. So here's our accumulated soybean exports, and this is, you can see we're running well behind the pace of last year, and so that's what's contributing to that weakness. And if you look at just what, whoops, I apologize. There's a graph here. This is not exports to China. It's the same as the graph before. So I apologize, missed that one. The exports to China have been flat. They're about the same as last year at this time. Not really gaining a lot. You do hear some talk about sales of corn and soybeans to China, but we're not talking about enough yet to move the line, and that's what the concern is. If you look around the world in terms of what's changed since last month for 2019 and 2020, you can see in general in the world, soybean production down about 2 million metric tons. A lot of that coming from Argentina and Brazil. And then if you look going out next year, notice that the world's jumping up in terms of soybean production by 26.6 million tons. A lot of that coming from the U.S. as our crop area recovers, but also you can see some here for Argentina and Brazil. And of course, this is crop that, remember, for 2021, when we're talking about that marketing year, this is crop in Argentina and Brazil that isn't going to get planted, until, November, December of 2020. So a lot can change between now and then. But right now, I would say it looks favorable that they will be having an expansion in area and subsequently more soybean production in that region. This supply and use, I included this in here. I know we just looked at this from a U.S. perspective, but this is from the world perspective. And what I wanted to point out to you here, at least since last month, we're actually a little bit tighter on ending stocks. Not much, but not hardly significant, but we are just a little bit tighter than we were. So conditions have improved just a little bit. But as we look out here next year, we're coming in with fewer beginning stocks as we begin the 2020 and 2021 marketing year. But we have that big increase in production. And as we look at trade and crush, and so basically meal and oil demand, that should help shrink the overall size of ending stocks, soybean ending stocks, by the end of next year. Yet we're still seeing a fairly weak soybean price. So something to keep in mind. Okay, so this is the August, the nearby futures for soybeans, and you can see we're we've been slipping here, just kind of bouncing around that 840 level, way below the 75th percentile, which was $99.34 for old crop. So not a lot of exciting marketing opportunities, and it may be time to start to take a look at if we get details here in the next week or so, as we're supposed to, on the on the new program about compensating for losses in prices. It may be time to start moving some of that crop on down the road before we get into July and August. And then if you look at the November futures, very similar path. The only reason I show you this long history is to show you that we did find there were some opportunities to market last year, throughout the season. And it's just that's what we try to watch for as we look forward this next year. It's going to be what's going to propel us back into that region would have to be some exports, some significant growth in soybean exports to China. Probably that doesn't happen until August, September timeline. And usually, we need to have the bins cleaned out for the next crop before we get into August much. So what I'm kind of saying is we may not have a good pricing option here for the old crop anymore much. We'll have to see what we can get perhaps out of the program. So with that, I'm going to turn it over to Wesley and let him talk about livestock. So here you go. I'm Wesley.
Thanks, John. Appreciate it. Marty, John, I'm going to have to teach you guys how to speak like a Southerner and talk a little faster. But we'll jump into the livestock here in about the last 5 minutes real quick. See if I can make this thing work. John, do you still have control? Oh, there we go. Maybe it's just a delayed reaction. So as I said, I've only got 5 minutes, so I'm not going to go a ton into the numbers. Just realize that what we're going to get to here in a minute is the slaughter packing plants issues are really what's causing a lot of this. And so for the most part, basically what USDA has done is take some of the beef and some of the pork, and they basically pushed it back further into 2020 and over into 2021. So if you think about the total production that we've been talking about for a number of years, that total production of all of our meats combined, was going to be significantly up this year, actually has a significant drop, but at the same time that we have a significant drop in prices. This slide here is probably one that will get economists debating and talking with USDA a lot. So the first sets of bars are beef, the middle's pork, and the last one's chicken. And so this is the Q1, Q2, and Q3, and a percentage of last year. And so in beef, pork, and chicken, packers saw what was coming as COVID was hitting the East and the West Coast. They knew it was coming, and so they were running packing plants at full bore, trying to push just as much product through as they could. The problem with packing houses is it is very, very much shoulder to shoulder work, standing next to the guy or gal next to you, and it is very, very conducive for disease spread. And if there is one thing that the meat industry has learned in this is just what a weak link that is for our whole supply chain. And there's going to be a lot of discussions going on about this for a very long time. But no doubt the blue bars being Q2 are going to be significantly down in all three meats. The interesting one that is up for a lot of debate is the green bar being the second half of 2020 is actually still USDA forecasting down. That is with the increase in slaughter weights. And as these packing plants come back on, they still don't think we're going to be able to push enough of it through. And that is probably one of the biggest questions that will remain unseen until we get into the latter half of the year is, can we get these plants back up to capacity quick enough? Can we keep workers healthy? So if you look at the price projections, I think I'm going to try to do this real quick if I can, slide on to the next one. May is the first month that we do the projection for the following year out there. And back last May when we first started for both beef and pork, 2020 was going to be our year. Look at where we started out. We started out with a annual average price of 121 for beef and 61, right at 60, I guess, for pork. So, 2020 was going to be our year until we just kept adding on pounds, and then till we got this major drop in price. So if you go back up here and just look at the price forecast issue, if you look at the annual average price for 2020 for fed steers, USDA has dropped it, as John said, I believe $7 all the way down to 104. And we are probably trending right now better than we could be, and part of that is just simply because of the meat price. But look at the barrel and gilt price of 43. I need to go back through each of the WASDE estimates and see how many months ago it was that we were hoping, because of ASF in China, that we were going to be looking at 58, and then, as I said earlier, all the way up to 60-cent hogs. If you look at those WASDE projections and split it out, not just on the annual, but on the quarterly basis, if you look at that red bar right there, that's Q1 coming out into Q2 actually this is Q2, I'm sorry, where I've got my dot, coming down into Q3 and 4 and moving on out into 2021. This is where I'm saying, if we are able to get these packing plants back up and going, what is that going to mean for all of this extra meat that we put on the market? Well, it's going to mean lower prices. There's no doubt about that. And so one of the things I think a lot of producers, and maybe I don't mean to be, too negative, but a lot of producers think if we just hold on and we just get a few more months through this, we're going to get right back up to where we were prior to COVID-19. And unfortunately, COVID-19 has got some ramifications that we're going to be living with for a very, very long time. Milk is also going to be suffering. Again, just look at just a few months ago where the annual milk price was and the drop off. If you break it out on a quarterly basis, hopefully 2020 Q4, by the time we get to the fourth quarter, hopefully we will have schools back in session, we'll have restaurants back going, and we'll be starting to climb out of that. Again, realize if COVID comes back in full force this fall, all of these projections are going to be drastically reduced. This chart right here, I know I'm running out of time, but that I want to camp out on for just a little bit. This is basically, I think, the 6-day moving average of slaughter numbers, of average daily cattle slaughter numbers. We have actually finally bottomed, there about the 1st of May, we finally bottomed with a number of plants that were closed and starting to space workers out. Thankfully, several of those plants were taken down for deep cleaning, brought those workers back in place. The president, enacted the Defense Act, got those plants trying back to reopen. But the question is, how quickly can we get that black line back up to where we were? I'll tell you, 2 weeks ago, this was looking extremely, extremely dismal. There's a lot more optimism in the market right now, simply where we've come in the last 2 weeks. It has been a tremendous turnaround. Prices in the local auctions have improved a lot. But what this is creating was, if we could take this black line and jump right back up to, well up over 100,000 head a day on a long-term basis, we still have a backlog of somewhere 500, 600,000 head. By the time we get all of this back up to capacity and production, slaughter capacity, we're probably going to be looking at 1 million head of finished cattle backlogged in the system. This is the average daily hog slaughter. They have actually managed to V and bounce back up a little bit quicker, but realize that the hog industry is a little bit tighter on slaughter capacity, even than the beef producers think that the beef industry in. So it's going to have more dramatic shifts up and down of how they control those plants. The big news, as everyone talks about, is the tremendous surge in meat prices. Boxed beef has went from pre-COVID as the total box price from just a little over 2 cents a pound to topped out to almost 5 cents a pound the other day. They did top a couple of days ago and have started to kind of tail a little bit. How quickly that tails down is going to have a lot to do with what happens to those finished steer prices and then backing up to the feeder and the calf markets going forward. It is interesting to note, though, that all of the beef products have been fairly consistently go up, whereas if I go to the pork industry, they've actually had some shifts. That purple line being the belly prices. It's kind of interesting when Dad goes to grilling out outside and eating more at home. By golly, Americans love bacon, and they're going to pile it on. So we've actually had a dramatic increase in the price of belly prices, and much higher than the other pork products. The one bright spot, as John kind of talked about, this is the weekly pork shipments to China are consistent, are consistently well above previous years. We are getting pork shipments into China. If it was not for this, if we did not have this happening, just think about how the pork industry would be reeling from these prices. And so again, this is all going to hinge, as John said. He made the comment about the lowering in consumption of meat products, and can we get that rebounded again in the last half of 2020 and going into 2021? If we can keep the slaughter plants going and we can produce it, I don't have a problem with how much that we can get consumers to eat it. My only question is at what price. Economists know if you want them to eat more, generally you have, unless demand, continues to grow, then you have to do it at a lower price. And unfortunately, our meat products have really had strong demand, and we've been able to benefit from that. My concern is what happens if not everyone goes back to work? What happens if some workers go back at a lower income? Those are situations that could be very dismal for the prices of meat going forward. John, I'll turn it back to you.
Thank you, Wesley, and sorry for not giving you more time. I got a little windy there at the first.
Not a problem.
So we have our next one is scheduled for the 15th of June. And for those of you out there who have been listening to these over the last few months, we've been doing them monthly. I would like to invite you to send me a note, an email, and just let me know if you'd like for these to continue. I do know that talking to the folks that have been presenting over the last year, they are certainly more than willing to continue, but we do want to make sure that it is something that you value and that is of demand. So don't hesitate to send me a note. The next one is June 15th at 1 o'clock, and you can see the link there to get in. And my email address is thecrusej@missouri.edu. So please don't hesitate to send me a note. With that, let me see if we can still hang on for just a few questions if anyone has any.